Picture this, you're in a bind. Your car's engine just gave out, and you need it fixed ASAP to keep your job. You're short on cash, and your next paycheck is still days away. You consider taking out a payday loan. It's quick, it's easy, and it seems like the perfect solution to your immediate problem. But is it? What if this quick solution ends up trapping you in more and more debt? Curious about what could go wrong? Let's find out. The allure of instant cash. So what makes payday loans so tempting? For starters, they're incredibly easy to get. You don't need a stellar credit score or a lengthy approval process. Just a few clicks online or a quick visit to a storefront, and you've got cash in hand or in your bank account. These loans seem like a godsend for people struggling to make ends meet between paychecks, especially the ones who have a bad credit score. The unbanked and underbanked also often feel they have no better alternatives. But here's the kicker. This convenience is a double-edged sword. While the ease and speed of payday loans make them seem like a simple solution to complex financial problems, the reality is far from simple. So before you take that quick cash, think long and hard. Is the immediate relief worth the long-term headache? The real cost. Now that you know what makes these loans so appealing, let's delve into why they can be a bad idea. At first glance, a payday loan might not seem that expensive. You might see a fee of $15 for every $100 borrowed and think it's reasonable. But if you look closer, that's an annual percentage rate or APR of 391%. That's way above what most financial experts consider affordable. And it doesn't stop there. If you can't pay the loan by your next paycheck, which is a common scenario, you'll have to extend the due date. And guess what? That means another fee. This cycle can go on, and before you know it, you owe more than you initially borrowed. It's a trap that's hard to get out of. Payday loans also don't help you build credit. So while you're getting a quick fix for your immediate needs, you're not doing anything to improve your financial situation in the long run. You're stuck in a loop, and it's a loop that can have serious consequences. The industry thrives on this trap, collecting up to $9.8 billion in fees every year from people who can't afford to pay them. And what happens if you refuse to pay back the loan? That's when the real nightmare begins. These companies have access to your bank account information. They can and will sue you. They can even threaten you with jail time. And because they know you're desperate, they know you'll be more likely to agree to even more unfavorable terms to avoid these consequences. It's a system designed to keep you in debt, to keep you paying fees, and to keep you coming back for more. But this is not all there is to it. This quick cash scheme comes at yet another high cost, the one often disguised in the form of hidden fees and charges. For instance, let's talk about the origination fee, a charge for processing the loan. This fee is often not clearly stated and can be a percentage of the loan amount, making it a significant added cost. Then there are rollover fees. Some lenders even charge a service fee for maintaining the loan, which is often buried deep in the fine print, making it easy to overlook. The problem is that these fees are not often transparent. Borrowers may think they're getting a loan for a certain amount, but with all these added fees, the cost of borrowing becomes much higher than initially thought. This lack of transparency is not just unfair, it's predatory. Lenders know that the people who are taking out these loans are often desperate and will agree to terms without fully understanding them. This is why it's crucial to read the fine print and ask questions. The target audience. When you think of someone likely to use a payday loan, you might imagine someone struggling financially. Now, in many cases, this is true. But surprisingly, it's not just them. The industry targets a broad range of people, especially those aged 25 to 49 without a college degree and earning between $15,000 and $25,000 a year. Why? These groups are often more financially vulnerable and desperate for quick cash. They're also more likely to have lower credit scores and less access to regular banking. This makes them perfect targets for payday loans. The industry counts on these folks returning for more loans, piling up fees each time. Thus, understanding who gets targeted helps us see the bigger issue of financial inequality. It shows us why these loans tempt those who can least afford them. the questionable practices. Now let's dive into the darker side of payday loans and the questionable practices that make this industry so controversial. One of the most glaring issues is the lack of thorough background checks. Many payday lenders don't even assess a borrower's ability to repay the loan. You only need an ID, proof of employment, and a bank account. This lack of scrutiny is a recipe for disaster, trapping borrowers in a never-ending loop they can't break free from. Another alarming practice is misleading advertising. And it doesn't stop there. Some lenders employ aggressive and unethical debt collection tactics. They may harass borrowers with incessant phone calls and even intimidate them into taking out more loans to pay off existing ones. This kind of behavior is not just unethical, it's exploitative and shows a complete disregard for the financial well-being of the borrowers. Alternatives to consider. But what should you do then if you ever find yourself in a tight spot financially? While it's easy to think that payday loans are the only way out, there are quite a few other options that can save you from the debt trap. For instance, personal loans from credit unions or banks offer lower interest rates and longer repayment terms. These institutions assess your ability to pay back, ensuring you're not biting off more than you can chew. Another option is to borrow from friends or family. It might be awkward, but it's better than getting stuck. Some people also turn to employer salary advances. Many companies offer this benefit to help employees in times of need. It's a one-time advance in your paycheck, which you pay back through future earnings. There's usually no interest, making it a much safer bet than payday loans. Peer-to-peer lending platforms are also gaining popularity. These platforms connect individual lenders with borrowers, bypassing traditional financial institutions. The interest rates are often lower, and you can choose a repayment plan that suits you. Some people might even opt for emergency assistance programs or grants offered by nonprofits and community organizations. So before you rush to a payday lender, consider these alternatives. They might take a bit more time and effort, but the long-term benefits far outweigh the immediate relief payday loans offer. In the end, isn't it better to solve the problem rather than put a temporary band-aid on it? Share your views in the comments below. If you liked the video, please consider subscribing and sharing so we can keep bringing more content like this. See you next time!